the S&P, the Nasdaq, whatever you look at, it's pretty much gone up in a straight line since the Fed and other central banks threw the kitchen sink at COVID last March. That the market has really been insulated from all of that, pricing in a vaccine-fueled recovery and just headed skyward. So I think everyone's perspective has kind of been skewed a little bit because, I mean, what are we on the Nasdaq? 2-3% off the record high, and people are getting, I think, perhaps a little bit hysterical, shall we say, about the price action that's taking place. I think what's happening with tech stocks is really twofold. One is the fact that you're now getting a market that is realizing, as we were just discussing before we went live, that there is light at the end of the tunnel of the pandemic. More and more vaccinations are taking place on a daily basis, and we're getting closer and closer to the end of this. And as we come out the other side of COVID, yes, working habits are going to change and people are going to spend more time doing things remotely, but by no means to the extent that they are now. They will be having meetings in person, etc. So our reliance on Zoom will decrease. So you've got that aspect that is obviously not just hitting tech stocks, but also sparking a rotation out of technology and into some of the more cyclical sectors that should pick up when we all get back to normal. And then I think the other thing that's hurting the tech sector is the rise that we've seen in treasury yields. And obviously yields are still very, very low by historical comparison. The 10-year treasury is at 1.48% this morning, which I don't think anyone can call high, but it is the highest that we've been in a year. And when pretty much the entirety of the mega cap tech names have been trading as essentially a proxy for long duration debt, because no one wanted to buy treasuries with such a deeply negative real yield, all of a sudden treasuries are now presenting an alternative. So I think tech's getting a little bit of a double whammy, but perspective is key. As I said, we're so close to the all-time high. A pullback is generally a sign of a healthy market. And and actually over the longer term, then I would expect equities to resume their bullish trend as history has often proved.
So back to business as usual, I suppose. Well, business back to usual pre-pandemic, I suppose.
Yeah, I think so. I mean, obviously, some things will change. I don't think people are going to be going into the office 5 days a week. I don't think people are going to be, doing as much business travel as they were before. But I don't think we're going to have anywhere near the reliance on technology in the next 12 months as we have had in the past 12 months. If you think about it now, what do people do? They work on Zoom all day and then they watch Netflix all evening because they have no other choice. When COVID is over, when lockdown restrictions lift, which we hope will be in the next sort of 3 or 4 months here in the UK, we'll be back to normal, then people will go and do what they did before. They'll go and play golf. They'll go out to the cinema. They'll go and drink in a pub with their friends, whatever it may be. But they're not going to spend the entirety of their life looking at an iPad screen using these streaming services. So I think it's only natural to assume that, some of these valuations that we've seen these companies trading at can't really be sustained in the longer run.
Yeah, I was actually just going to ask you about the valuation. So you kind of just answered the question. But speaking of valuations and denominators, as we've been seeing lately on Twitter, my God, I mean, it's absolutely ridiculous. And I can't actually even believe that we are discussing this, but I do think it's worth a mention, given that there's this ridiculousness popping its ugly head up every now and again of take this numerator and divide it by that denominator. And I love the example that you used this morning of, I'm going to use my denominator as cheeseburgers, and then everything will be measured against that. What do you make of this, Mike? I mean, it's just, I can't help laughing, but I would love to get your real-time perspective of this.
I think it's just utterly ridiculous, to be quite frank. I'm not even sure whether it's worth giving it, any more time than it's already had.
A minute.
Yeah, it's just, it's one of those things where, if you want to try and prove a point that you're making, you can always divide by something, or that you can find a way of proving that point if you do enough maths and look hard enough for a statistic and data point to prove what you're trying to say. But you just need some context. The other thing that annoys me is all these dual axis charts. People plotting money supply against the S&P 500. Yeah, there probably is a link, but if I plotted money supply against COVID cases, I've proved there's a link there, and there isn't. It's the whole correlation causation thing. So yeah, I think it's slightly ridiculous, to be quite honest. And it's just a shame that so many people think that kind of thing is insightful analysis when it really isn't, to be honest.
It can make for a good looking chart. I think, what was the last one? It was like break even yields and the price of gold, and it put out like an R squared of 0.995 or something like that. But then when everyone pointed out, well, you can't do regressions with pure prices, and the guy kind of just went silent on it. But some of these things do seem ridiculous, and it's the same thing with the denominator problem as well. I mean, what was the last one? It's like probably gold to the power of M1 or something like that as your denominator. But I mean, it's like you say, you can prove any point if you look hard enough for the right statistic, just to and then whip out the dual y-axis, and suddenly you've got something that looks quite nice, but then you spend 2 minutes digging into it and you're like, well, actually this is completely useless.
Yeah, exactly that. And I think it comes back to a point that I've probably made countless times before about awareness, and people just either aren't aware of how things work, or are, for whatever reason, don't want to look into how relationships work these days, and almost just see one of these things and think, oh, that looks very pretty on a chart, I'll use that, I'll take that on board. Whereas if you spend less than 5 minutes, as you say, Jamie, actually investigating that a little bit deeper, then you'd quite quickly disprove it, or even you may prove it, and then it actually turns out to be useful. But it's just one of those where a little bit of a closer look is all you really need. And on something like these denominators that seem to be the latest fad, a little bit of a closer look quite quickly shows you how ridiculous the whole thing is.
Yeah, I also think people don't really understand things like inflation. And I mean, when it comes to Bitcoin, I know next to nothing about how it actually works, other than what I believe is called the greater fool theory, where, for those who might be listening and don't know, it simply means you're hoping that someone is going to be a bigger fool than you to buy at a higher price, is essentially speaking. But I've also been reading a bit more about the arguments that inflation is not likely to take place in the US or in the developed world anytime soon, due to the velocity of money, as in idle money versus active money. Would you care to just elaborate a bit more on that? I would love to hear your explanation of it, for the benefit of the viewers.
Yeah, of course. I mean, this is the big question, isn't it? That everyone has an opinion on at the minute, inflation, because you seem to have two very distinct camps, where one side of the argument thinks that inflation is going to be at about 5% by the end of this year and we'll never get on top of it, and the other thinks that we're going to enter some massive deflationary spiral and everyone's going to turn out to be Japan in 5 years' time. I would probably be somewhere in the middle of that. I think you're going to see a big move higher in inflation in Q2. We know that because of the base effects coming in from last year. Prices absolutely tumbled when the pandemic first hit. We do a year-on-year change to work out CPI. They're obviously going to be significantly higher this year, purely because things are open again. So we can pretty much ignore that. I think we are going to see prices rise throughout the remainder of this year. There's a number of reasons why I think that. One is the sheer amount of stimulus that is being put into the economy. Not so much here in the UK, but particularly in the United States, where you had 900 billion in December, early January. Then you've got Biden doing another 1.9 trillion now, plans for another, I think, 3 or 4 trillion on infrastructure towards the second half of the year. You've also got the whole issue of pent up demand. And I know there's some debate about this theory of everyone's going to suddenly go out and spend, and how many people have built up savings during the pandemic. But if you look at the data, I think more people than not have improved their financial situation over the course of the pandemic. There was a good chart out from the Gertjan Vliega from the Bank of England. The top 3 income quintiles in the UK have all got a better financial position now than they had pre-COVID. So I think some of that spending will be inflationary. And then you've got the issue of rising commodity prices. Obviously, we know all about oil, but you've also got copper prices rising, food prices are rising significantly as well. And you've got a load of shipping delays. There are big problems in supply chains and in getting products actually around the world and getting production chains moving. So I think I would have an inflationary bias for the remainder of this year. Whether that is maintained in the longer term, I think is a lot more doubtful. I think whether we see, not necessarily runaway inflation, but sustained higher inflation from 2022 onwards, that really depends on, one, how quickly the labour market can recover from COVID, because if you've got a lot of slack in the labour market, you're really not going to have significant price pressures building. Two, how people react after COVID. Do people maintain higher savings balances and that sort of thing? And 3, what policy does after COVID? Do we see a significant tightening of fiscal policy, or do things remain as loose as they are at the moment? And I think longer term, I'm definitely not thinking we're going to get the sort of runaway inflation that we had in the 60s and 70s. I would say inflation will probably be higher in the next 10 years than it has been in the last 10, because coming out of the financial crisis, we had monetary policy very, very loose, and actually fiscal policy relatively tight, especially with all the austerity that was going on. This time we've got both running very loose. So I would say that inflation will be higher, but actually that's what central banks are telling us they want. So if CPI runs at 2.5%, is that a massive problem? Probably not. If it runs at 3.5%, then that is a problem, but I don't think we're going to sustain that on a long-term basis. So I guess in short, yes, we will see inflation this year. No, it's probably not something to worry about in terms of the longer run.
No, you raised a good point then. I know halfway through when you were saying that, you were saying about the energy prices, and obviously that's kind of been somewhat of a hot topic, maybe not in the last few days, but certainly over the last few weeks. And we had the JP Morgan piece with Marco, and then previously we had I forget the guy's name, but the guy from Goldman Sachs talking about
Jeff Curry.
Well, that's the one. Also a PhD, but somewhat less well known than Marco. But yeah, so obviously they've been talking about this super cycle idea, and that over the last there's these kind of 12-year cycles where energy prices rise exceptionally high, and then they fall exceptionally low. And they kind of noted that, last April with crude prices going, front crude futures going negative, that marked the bottom and the start of a new super cycle. So I'm just curious to hear your thoughts on whether or not we see $150 barrel of crude again.
I mean, I'm not a commodities expert, certainly not in the league of those two that you just mentioned. But my kind of feeling reading these notes that are being put out and reading the various articles that have been written on this, because as you say, it is getting a heck of a lot of airtime at the moment. I guess I would just be a little bit cautious until the economy opens up. It's very, very difficult to gauge what demand is going to be until things are actually back to some degree of normality. When we get to the second half of the year, then you can probably call, are we at the start of something, or was this just a nearer term recovery that will peter out? But I think it's quite hard to make those calls when, the vast majority of the global economy is still shut down and will be shut down for another couple of months.
Yeah, I was wondering about that because, if you invest in the stock market, normally the assumption is that the market is very forward-looking. say a year, 2 years, or whatever the time frame might be. But you just raised an interesting question or point rather that I would like to address. Are commodities the same too in that regard? Are they also forward-looking or more in terms of immediate term supply and demand that will influence the price?
I mean, I think there's a bit of both there. I mean, obviously, every market is forward-looking because at the heart of all financial markets, they are discounting machines that are discounting what's going on in the future, pricing that in, and coming up with what buyers and sellers see as a fair value for whatever the asset is in question, and that is what moves a market at the heart of it. I think the other thing that you've obviously got to bear in mind with commodities, particularly with oil, is what OPEC are doing. Obviously there's an OPEC meeting today. It may run into tomorrow. Whether or not they extend their production cuts is the key question, and how long and how much of a production cut they extend. But really at the heart of it, all markets are forward looking. The question really is, how far forward is the market looking? You would generally say stocks are probably 12 to 18 months. At least that's the track record that they have had over the last kind of year or so, judging by what we've seen. I would say the FX market is looking ahead over a much shorter time frame than that, and commodities probably somewhere in the middle.
Okay, yeah, thanks. That answers the question. Because I haven't been sure as to how to look at commodities in the past, because when we looked at copper prices and what's that other one we looked at, Jamie? Zinc. I think we were looking at zinc at one point.
Yeah.
And that had also made a massive recovery relative to the lows we saw back in March, April of 2020. But as you rightfully said, Mike, many parts of the world are still completely shut down, and yet these prices have recovered to an incredibly large extent, as if they're pricing in normal levels of production and demand. So thanks for answering that.
I mean, I suppose the question is, are they pricing in the level of demand that we saw pre-COVID, or are they pricing in a level of demand higher than that we saw pre-COVID? I would probably say it's the former rather than the latter at the moment.
Yeah, I think so. I think so too. Just based on what we are seeing. I mean, if I look at the vaccine rollout that has been, or the rate of the rollout rather, in the UK, I mean, you guys have done pretty damn well, all things considered. Relative to many other parts of the world. And I see a lot of criticism going on Twitter and on LinkedIn, and sometimes I just do think, you know what, guys, if you were in charge, would you have done such an amazingly splendid job where you would have done so much better? I mean, the UK is actually one of the leaders in terms of vaccine rollout compared to over here, for instance, where I think we've procured 20 million doses, give or take, and that's only going to be rolled out over the next few months. So herd immunity is going to take a lot longer to get. So we might find that the UK economy actually opens up a lot quicker than many other EU countries, for instance, and that's definitely going to have a positive effect.
Yeah, definitely. I mean, I was thinking about this the other day, and as you say, I think the UK has probably got three things right throughout COVID, because let's be honest, we've got a lot wrong. And as you say, leaders around the world will analyze and evaluate and have their performance analyzed and evaluated for years to come. But I think the three things that we've done well are: one, the coordination, perhaps too close coordination, between the Treasury and the Bank of England in the early phases of COVID was pretty much exemplary. The second thing that we've done well is the genomic sequencing in terms of finding the variants of COVID that are popping up. The reason why they all seem to be in the UK is because we're testing, I think, something like 30% of all the genomic sequencing in the world is being done in the UK. And if we get cases below 1,000, which should happen probably within the next sort of 6 weeks or so, then we will be able to sequence every single case of COVID. So that is quite an achievement. And then the third thing, as you say, is the vaccine rollout. And the simple equation is the faster you vaccinate, the faster you get immunity, the faster you get back to normal. And that is why we saw sterling do so well over the first couple of months of the year. Cable going from kind of 132 up to 142, and euro sterling falling from around 90 cent to just around 85 cent. But I think, again, this comes back to pricing things in, because I think UK assets and the pound have priced in a hell of a lot of good news now. And I think it's questionable what the next catalyst will be for further upside there. But as you say, I'm certainly glad of the rollout. I think it's looking like, before the end of June, I could be jabbed, and I'm probably the very bottom of all the priority lists that are out there. So very, very impressive indeed. And, it bodes well for us having something of a normal summer. I just hope that because we have so many doses, once we have done immunizing everyone here, we start to give those doses out to less developed countries who haven't been able to order as many doses as others, particularly because this is an idea I think is going to gather pace as the year goes on. This idea of sort of vaccine diplomacy and soft power. Because if, for example, you look at South America, parts of Africa, parts of Asia, if the UK or Europe or the US don't give them vaccine doses, then who will? Well, it's going to be China and Russia. And do we really want China and Russia having that sort of influence over other countries? No, we don't. So, I'd hope that we start to look at that as our program begins to move to a conclusion.
Yeah, I agree with you there. It's always good to use that soft diplomacy as you refer to it, and I think that's an often overlooked factor in terms of building good relationships and trade agreements with other countries. The other thing that I also wanted to speak about, now that you mentioned the pound, was that I did notice that cable actually went the opposite way of what many people thought it would. Many of the remainers thought that the pound would crash all the way down to 110 against the dollar or the euro. I can't remember which one it was. Now it's actually just shy of 140 at the moment.
Yeah.
If we look at it, the pound dollar rate. So I guess there's a lot more optimism in the air than what was previously anticipated. But yesterday I saw that the corporate tax rate was raised from, I believe it was 19 to 25. Have I got that right?
Yeah, that's right. Yeah.
Is that going to have any positive or negative impact on the pound, or does that not really do anything to the currency's value?
I think in the very near term, it's not going to do anything at all. Mainly because the increase doesn't come in until 2023. So we've got a couple of years of sort of leeway before that hike actually comes in. Okay. I think in the longer run, there is a danger, obviously, of that making the UK economy less competitive compared to its peers. And obviously that could have a detrimental impact on growth, and obviously that would have a knock-on detrimental impact on the pound. I think the one thing I would say is that, there's a lot of talk, and the line the Treasury are trying to sort of spin on this is that, even at 25%, there's various new deductions that will cushion the blow, and it will still be the lowest corporate tax rate in the G7. Well, yes, that's fine, and that is completely and utterly true. You can't dispute that. But any tax hike will narrow the gap between the UK and other nations in the G7, because we were the lowest by quite some way. And that will, by definition, make the UK economy less competitive with its international peers. So I can understand why the Treasury are doing it, because they want to raise revenue, and they want to begin paying back the damage and the expense that COVID has caused. But I do worry that in a few years' time, we could be looking at it as a bit of a mistake. So I don't think it's going to impact UK assets in the immediate term, but 2 or 3 years down the line, if it poses a significant headwind to growth here in the UK, then yes, that will obviously impact the value of the pound.
Go ahead, Jamie. Jamie, are you there?
He's on mute.
Sorry, guys, my wife was just a little bit funny, but don't worry, I'm back now, and I was on mute. Yeah. No, I mean, it's all really quite interesting points, isn't it? Because looking at the budget yesterday, and I suppose those sorts of events, they tend, well, in my short experience so far, they tend to be fairly overhyped. There was a lot of talk around it, but obviously a lot of stuff was leaked prior. But really, next to no market movement, especially in FX, I mean, that was really just sort of like a still lake. I think it moved overnight probably more than it did when Sunak was up there. But yeah, some good points. And obviously, as we look further out, because Adrian, like you say, the corporate tax hike to 25%, well, it won't come in until 2023. And so the near term, like you say, Mike, wouldn't expect it to make much difference, and that sort of thing will be interesting to see in times gone by as narratives start to change, because obviously the narrative right now, well, at least from stuff that I've been reading, seems to be very driven by the vaccine disparities. So Danske put out a research piece saying that euro pound is really being driven by these vaccine disparities, where the European Union and their vaccine progress is leagues below where the UK is currently. I wonder then what the next step will be. What's going to be that next driving factor? I do think that inflation expectations and the realization of inflation versus expectation will be an interesting one, because I mean, like we said before, there are these two quite bipolar camps, where one is pushing for deflation, the other one pushing for inflation. But I wonder what happens if we really do just hit a kind of very flat boundary where we're not exceeding expectations, but at the same time we're not dropping massively below it. What effect that will start to have on currency markets, and probably the focus for me would be equity markets. Where does that lead? Where does that leave US equity markets? What will the Fed decide to do if everything is unchanged? I would imagine that we just stay close to the zero bound as we are now.
Yeah, I mean, I think that if nothing changes, if we just kind of plod along with after this year's out the way, because reading the economy this year is going to be as much of a nightmare as it was last year. But in the coming years, if we plod along with relatively stable growth, with unemployment coming down at a tenth or two on a monthly basis, and price pressures remaining subdued, then I guess there's two options for the Fed. One is to do nothing and just to persevere with what they're doing, which is 80 billion of treasuries, 120 billion of mortgage-backed securities, and just keep going with it. The other option is to do more. I don't think they would do more. I think they would just persevere and I guess cross their fingers. But if you see rates remain at zero for the foreseeable future, it's going to be probably the end of 2023 at the absolute earliest to think about hiking rates. Then that's obviously bullish for equities. We all know that. I think the more interesting kind of divergence that's taking place is between fiscal policies, because in the UK and in Europe, spending is slowing, and the Treasury, as we saw yesterday and have just discussed, are already looking at balancing the books and getting the deficit back to more sustainable levels over the next 5 or 6 years. Whereas in the US, they are still splashing the cash at quite an unprecedented rate. Now, obviously, there's a political angle here because Biden has only been president for, well, probably about 6 weeks or so since he was inaugurated now, maybe not even that long. So he can't exactly come in and do nothing, because people will say, you know, we elected you to do X, Y, Z, why haven't you done it? And you don't have that angle here in Europe. But I just wonder which side of that debate will end up coming out on top. Is not necessarily tightening fiscal policy, but beginning to rein things in a little bit now the right decision, or is splashing the cash the right decision? And whichever of those prove to be the correct way to do things, I think assets in that block are likely to outperform.
Does the Fed have, for lack of a better word, a tipping point where they will not be able to keep purchasing these MBAs, as you mentioned, and treasury bonds? I mean, when do they start purchasing equities for all we know? Is that even a possibility, or more of a theoretical concept at this stage?
I think very much theoretical at this point. I think back probably 2018, 2019, I remember we were all kind of talking about this, could the Fed buy stocks? I think there are some legal constraints around them not being able to do it.
Okay.
And also, I don't think that, you know, they would need to do it at the moment. It's not as if the economy needs, you know, any more stimulus than it has already had right now. I don't think they're going to go down that route. There's been absolutely no indication that they would. I think the bigger issue for the Fed and actually for central banks more broadly is, you know, what is the point of QE? Now, the reaction back last March, kind of this time last year almost, when rates were being slashed and bond purchases were being announced and all the rest of it, completely understandable. You're faced with a crisis, a pandemic, no one's ever seen it before. The market is not only were equities tumbling, but also you have, you know, the treasury market was pretty much on the verge of completely seizing up. So doing anything and everything you can is understandable. But I guess the question now is, you know, why are the Fed still buying $80 billion worth of treasuries a month? What's the aim of it? You know, because is it to keep yields low? Well, the front end of the curve is anchored because you've said you're going to keep rates low for 3 years, and the long end of the curve, as we've seen, has steepened pretty dramatically over the last 6 months. So I just don't know whether central, and I don't mean this in a condescending way, but I don't know whether they know what they're doing at this point, and in terms of what the aim of their policy is. Is it to provide stimulus? Because it isn't, let's be honest. Lowering interest rates from, here in the UK, for instance, from 0.75% to 0.1%, that's not going to make a difference. If you lowered it from 5 to 0, then yeah, that's going to make a difference. But moving it 65 basis points hardly moves the dial. And yeah, QE worked last year, and it probably worked coming out of the financial crisis. But is it actually having an effect now, apart from just signaling to the market that, yeah, we're still here, we're not going away?
I think I can build onto what you said, and you know, feel free to please correct me if I'm wrong. But this is the way I see it. When QE was originally implemented back in, when was it, 2009 or 2010 under Bernanke? I can't remember now the exact year, but I think it was 2009. Then we could argue that it was a steroid used for performance recovery, because, for instance, you can use the analogy of saying, you know, someone sustained a very bad sports injury, they fractured their leg or their kneecap, and you use anabolic steroids to help the patient recover. You go through physiotherapy, rehabilitation, and all that stuff. So I view QE as originally being a rehabilitation substance, but now it's become a performance enhancing substance. And that's where it becomes very problematic. It's almost the equivalent of taking one of my favorite athletes, called Usain Bolt, and you just pump the guy full of steroids. I mean, you literally fill him to the freaking brim with this stuff. And suddenly he doesn't run a sub 10 100, but a sub 9 100. And people just go, wow, look at this. This is so amazing. He's clocking these times. But after a while, the effects start to wear off a bit and he has to go back to normal. But the crowds, in other words, the market doesn't particularly like that. They want more of these sub 9 times. Does that kind of ring true for you? Because that's an analogy that I use, but I could obviously be wrong.
Yeah, I think that's a great analogy. Actually, I couldn't have put that better myself. I think the other thing that I would mention is, and you alluded to it there, weaning the market off quantitative easing is, as we saw before, a very, very difficult task. And there's now increasing chatter about potentially yield curve control in the United States. But weaning the market off of that would be a completely different ballgame. It would make the taper tantrum look like a little bit of handbags compared to what you would see if yield curve control had to be undone at some point. So I do wonder whether, one, we're going down a little bit of a dangerous route in terms of central bank intervention in the markets when it quite clearly isn't necessary at the moment, and two, I worry about whether this is a one-way path, and whether we start looking at in, as you say, but are we going to look at ETFs or equities? What else are these central banks going to end up purchasing in the decades to come? And at some point, they are going to run out of tools. Interest rates are already nowhere near as efficient as they were previously. We're going to get to that point with QE. What happens then?
Yeah, I mean, can we actually even raise interest rates in the future? That's a question that I've been, I wouldn't say I haven't had arguments about this, but I've had many discussions with people far smarter than myself regarding this, and no one has really been able to give a definitive answer, as in if we'll ever see, say, 3% interest rates again. I don't know what you think, Mike, but it does seem unlikely at this particular point.
Yeah, it really does seem unlikely. I mean, if you look at the benchmark rate of any central bank over the last 3-4 decades, you can probably go back. It's very clearly a series of lower highs. If you look at the Fed funds rate, I think we peaked at just shy of 10% in the early 90s. We got to just about 7.5% in the late 90s around the .com. You then got to 5% ahead of the financial crisis, and then you got to 2.5% last time around. So it is a very clear downtrend that interest rates are in, a sort of secular decline. And yeah, I think it's going to be very, very difficult indeed to get interest rates back. Even 1% seems a challenge at this point, and that's only 3 rate hikes away for the Fed and for a whole host of other central banks. But if you think the Fed's got a problem, I mean, the ECB have got an even bigger issue with negative 0.5% on the deposit rate. I really don't know how you pull that back.
Yeah, but Mike, why, forgive me for my ignorance for actually even asking this question, but I really don't know. Why would you put your money into bonds with a negative yield? I simply don't get it.
Well, I mean, the one reason why you would do it, well, there's two. One, because you have to. If you're a pension fund or something like that, and you've got various constraints around what you can invest in, then you haven't got a choice. You've got to buy it, whatever the price, whatever the yield is. The other reason you would do it is because you're not going to hold it to maturity. So if you buy a 10-year bund now, I mean, where's the yield on a 10-year bund is at negative 30 basis points now. You could think that in 3 years' time, that yield is going to be negative 60. Obviously, yield moves inversely to price, and you can then sell that for a profit. So I guess it comes back to the greater fool idea that you were discussing earlier. But yeah, you really wouldn't be buying that to hold it to maturity. And that is why what central banks are doing and where yield yields are forces people further out along the risk spectrum and into equities. And that really, for me, is probably the main reason why stocks have powered so much higher over the last 9 months or so, because a 10-year at 60 basis points is not attractive to anyone. Suddenly you get a 10-year at 1.5%, or maybe even 2% by the end of this year, and that is a lot more attractive. So this whole idea of there being no alternative to equities that has lasted for the last 9 months, is it going to last for another 9 months? I'm not so sure.
Okay, no, thanks for that, because I literally didn't know how to answer that question on a few prior occasions where I have been asked, why is the German Bund, as you mentioned, at a negative yield, and people are obviously still investing in it. So thanks. You just brought a lot of clarity to that conundrum I was dealing with. But go ahead,
I
Jamie.
guess the other aspect is safety. If you want to buy European government debt, or you have to buy European government debt for some reason, then really Germany is the only place that you can go. I don't think anyone is seriously going to be wanting to snap your hand off to buy Greek debt or something like that.
No, hell no.
When everything is being backstopped by the ECB, that's just going to drag yields down across the continent.
Yeah, but I think the ECB is, sorry to Jamie, I know you want to ask a question, but just while we're on this topic quickly, one of the things that did occur to me a while ago was that the ECB does face one problem that the Fed doesn't. And that is that in the US, all US treasuries are created equal. I mean, they're issued by the same place. But in the EU, not all bonds are created equal. Not all countries are equal. So that's a bit of a problem to form a standardized kind of yield, I would imagine.
Oh, massively. I mean, you remember, it must have been, it will be a week next week, actually, when Christine Lagarde, the ECB president, said it's not our job to close spreads. Essentially, it's not our job to make sure that the spreads between core and periphery Eurozone debt are relatively narrow. Now, I'm not going to have a rant about Lagarde here. It's not the time and the place for it. I've done that far too many times before.
We feel the same way.
Good. This is the ECB's issue. And the other, it's the broader problem with the Eurozone is that you have economies that are so different without a fiscal union underpinning it all. So the ECB have to act as kind of the glue to hold it all together, which is why they can pretty much never stop with their QE programs that they're keeping in place. And that's the big difference with the US, because as you say, with the US, yes, it's a collection of 50 different states, but they all have, it is a proper country, it is a fiscal union, they all issue treasuries, et cetera. They don't have that in the Eurozone. And it makes, one, the ECB's job a lot harder, not that they know what they're doing in the first place, and two, it means that they have to stay a lot looser than perhaps they would otherwise want to.
Actually, Mike, whilst we're on the topic of government debt, I suppose probably would be a good time to talk about the move in rates just a few days ago, actually. So it was obviously one of the biggest down, and I'm looking at the chart, actually, one of the biggest down moves in rates in terms of a sort of Z-score, a number of standard deviations away from the mean. What exactly was going on there? Because it's wreaked havoc to, tech mostly. Other equities have done slightly better, but it really has damaged tech. So I wonder if you could shed some light and just tell me, if at least, what is going on there.
I think what you're really seeing is the market testing the Fed. In the shortest sense of it, it is that you've had the Fed come out for a number of weeks now and say that, and we heard this from Powell at his congressional testimony twice last week as it happened, or it may have been the week before. Actually, I can't remember now. Time seems to go by so quickly. No, it was last week he spoke, and essentially say that the rise in yields is fine. We don't have a problem with it. We think it reflects optimism around the economic outlook, which is right. It does, but I guess the market has then taken that and gone, okay, well, how happy with it? How happy are you with it? How far can we force the issue? And I think you've got a bias for rates to move higher. You then had a really poor 7-year auction last Thursday, and that kind of acted as a catalyst for bonds to really sell off across the curve, particularly in the belly of the curve. Obviously we have stabilized since then. The 10-year yield hitting, I think, 1.58% was the high we reached last week. But I think really it was just a sign of the market saying to the Fed, okay, you're happy with it, but how far can we push this before you say you're unhappy with it? And that's really what we've seen again this week. I mean, we saw another kind of 6 or 7 basis point jump up in yields yesterday, and it seems like every man and his dog is going to be hanging on every single word that Powell has to say later. About whether the Fed are going to push back on this a little bit or not. And I think whether they do depends on what happens with financial conditions more broadly. Because if you look at the market, I don't think we're yet at the stage where rising yields are a credibility problem for the Fed. The belly of the front end of the curve, is still anchored pretty much at zero, pretty much at the Fed funds rate. You're seeing a few hikes begin to be priced in towards the back end of 2023, if you look at things like Eurodollars. But actually, long duration yields rise in the early stage of an economic recovery anyway. Real yields are still negative. Financial conditions are still close to their loosest on record, or at least they were when I looked at them on Monday. They may have nudged a little tighter since then. And I think until you see either conditions tighten significantly or the market become disorderly, and by that I mean liquidity start to dry up, bid-ask spreads widen out significantly more than they have, then my hunch is that the Fed are kind of happy with what's going on. Not necessarily happy, but content with what's going on. I suppose the risk is that once again, as has happened countless times in the past, we end up with the market bullying the Fed into doing something that perhaps they don't want to do, whether that's buying more debt at the long end of the curve, twisting their purchases, yield curve control, whatever it may be. I guess that is the risk to be aware of.
No, thanks for that. That certainly cleared some things up for me, because I was looking at it with some confusion, but certainly makes a lot more sense now. Market testing the Fed.
Yeah, that's the way I would look at it, and I think the moves in the United States have kind of spilled over elsewhere as well, and now you've got the market kind of testing every central bank, if you like. I mean, gilt yields have quadrupled this year. I think the Bund yield has doubled this year. Aussie yields were up something stupid like 60 basis points last week, and you've seen the RBA increase their bond purchases at the long end of the Aussie curve. The ECB has started to, they tried to jawbone ECB Eurozone yields a bit lower on Monday, and then yesterday you had some sources comments coming out saying that actually there's no concern about it. So I don't think they've got a clue what they're trying to do, but really I think the market is now waiting to see what the Fed do, and we will wait to see what Powell has to say later, I guess.
Yeah, and that will certainly be an interesting one, and because it's the Fed blackout period very soon, isn't it, before their next meeting?
Yeah, close of play Friday is the start of the blackout. So I think really it's a case of Powell talking today, and then perhaps either a clarification or a clearing up exercise tomorrow before we don't hear from them ahead of the March FOMC. But I was saying to our guys on a call this morning that we've gone from, at the start of the year, we were kind of thinking that the Fed are going to be pretty boring for the first 3 quarters of the year. We might hear some murmuring about tapering asset purchases in Q4, but probably not going to change policy nonetheless. to suddenly going, actually, the meeting in 2 weeks is now potentially a live meeting where you could see some policy changes.
Yeah, I have to agree with you on that. That they will probably be as boring as possible to, shall we say, keep the status quo as is, without ruffling too many feathers. I mean, as you said, yields at 1.4% or even 1.5 are ridiculously low. But this also shows me how fragile the market actually is. If yields of 1.4% could literally cause, shall I call it a childish temper tantrum, so to speak?
Yeah.
It just feels like it.
I think the issue is not necessarily the absolute level of yields. I mean, yes, that obviously is
So the relative
important.
one.
It's more the speed at which we've moved. The fact that we've gone from kind of 0.6, 0.7% on a 10-year at the beginning of Q3 last year to 1.5% now is a very big move in a relatively short space of time. And when you've got a market that is so sensitive to rates being at zero for the foreseeable future, we've kind of extrapolated easy policy forever is what the stock market has done. It's then kind of no surprise to see that have an impact. So I don't necessarily, I think perhaps people are getting a bit too hung up on the absolute level. I mean, you've seen, for instance, last week, everyone was saying 1.5% on a 10-year. You've got to watch it. 1.5%.
Oh, gosh,
that's when it's going to happen. As soon as we hit 1.5%, no, 1.75%. That's where it'll impact things. Next, it will be 2, then 2.5. It's the speed at which we move. And I pulled up a very crude way of extrapolating this last week, I think it was, and when we were pretty much at 1.45, and if we moved 10 basis points a week as we had been doing throughout February, we'd be at 3% by June. Whereas if we move 2 basis points a week, which is what we'd been doing as the average over Q4, then I think we'd be at 1.75% by June. So it's really the speed at which things are moving rather than the absolute level. Any move higher is obviously going to make things a bit choppy, as we're seeing, and make the equity market get quite wobbly. But I think pinning an absolute level on it is a little bit of a mug's game, perhaps.
Yeah, but Mike, you bring up an incredibly interesting point here by using the relative speed versus absolute levels, which I think is a perfectly reasonable and valid way of looking at it. But if we evaluate the debt levels of these tech companies who obviously did lever up a bit during the yield troughs back in, when was it, March, April?
Yeah.
I mean, are they really going to be in that much trouble if yields just double from where they are? Or is this, once again, as you said, just maybe a bit overdone? I'm not sure.
I think it is a little bit overdone, but I think the other thing is that everyone is significantly more sensitive to rising yields now than probably at any point in the past, because we've become so used to the fact that yields are low and will remain low. It's not just tech stocks, it's also governments as well. There was a piece of analysis out in the Financial Times on Saturday. The one thing in the Financial Times that was probably true that day, the paper's gone so far downhill of late, saying that the cost of servicing debt, government debt in the UK, if inflation were to rise by 1%, if long-term gilt yields were to rise by 1%, and bank rate were to rise by 1%, we'd be paying 25 billion quid a year more just to service our debt. Now, even if you take the rise in bank rate out of that, you're still looking at 15 billion. And 1% higher inflation and a 10-year gilt at 1.7%, I don't think either of those are out of the question, to be quite honest.
Okay, wow. I mean that puts things into a massive perspective. So thanks for clarifying that, because I was wondering at one point, is this really going to cripple these companies as much as you said? But I did forget about the fact that governments obviously have to pay interest on the debt that they issue. So yeah, it's an incredibly valid way of looking at it.
Yeah.
Jamie, sorry, go ahead, Mike.
No, go on, Jamie.
Oh, sorry, I didn't say anything.
Oh, sorry, I thought you did say something. That's why I just said go ahead. My bad. No. Yeah, I really find this field so fascinating, and I mean that's why, for instance, just to glance over the whole denominator numerator nonsense that we briefly discussed earlier, it boils down again to this single point that markets are not trigonometry, calculus, or you can use those to kind of help you, calculate a few things, no pun intended. But if you think you can just simply say, oh, the opposite of sin is cosine, or use trigonometry, what's it called, trigonometry?
Yeah.
Is that it, Jim? Yeah. If you think you can just use freaking trigonometry to make sense of something, you're out of your damn mind. I mean, this is not the way the real world works.
No, and that's the point. Markets don't move in straight lines. That's what people sort of need to understand. And I think this is almost the problem that we've had with the equity market over the last year. People have just become so used to it going up in one direction in a straight line relatively quickly, and assume that's going to happen forever, when it quite obviously won't. That's not how any market works, and I think people just need to realize that. And as you say, I think the awareness piece that we were discussing earlier is really the key part, isn't it?
Yeah, absolutely. And I think also whenever markets reach tops or bottoms or show any signs of changing direction, then watch all the so-called geniuses crop up with their, as David alluded to, market porn. I love that term though. That's such a brilliant way to describe it, market porn, because that's essentially what it is. And this is why, one of the reasons why I personally love talking to you, Mike, because you are one of the voices of reason in this world that I really enjoy engaging with, because you offer a very balanced and should I say objective opinion on things, as opposed to getting caught up in all this hype, in all this turmoil. And this is what I would like to see more of, from policymakers, for instance. If they had your view, I tell you, the world would be a different place. My God, completely different place. It would. I'm not joking. I'm not just saying that. I actually do mean it. I think with more of a balanced perspective on things, and as you said, keeping perspective, as opposed to getting caught up in this mania of things that we often see.
Yeah. Well, thank you very much. I mean, I think mania and perspective are the two things that are really problematic, actually, about markets in general. Because what you have is a situation where you've got 24-hour news channels that have to have a story because they've got to have something to fill the airtime on their channel. You've got non-stop social media where anyone can be an expert on anything and suddenly start a new trend or hype around a certain thing, as we've seen with what was the thing that Elon Musk was talking about the other week? Not Bitcoin, the other one.
Dogecoin, was it?
Dogecoin.
That's the one.
Or something.
Yeah, and suddenly dodgy, I think. And then all of a sudden, that can become the latest thing.
Or GameStop.
GameStop, exactly. Yeah, and that became a complete and utter frenzy, didn't it? Because then all of us, you had not just the price action, the short squeeze, the gamma squeeze, etc. You then had, people trying to claim there was some massive conspiracy out there and all the rest of it.
Yes.
And I just think, more people need to take a step back, look at things in the slightly bigger picture. And actually, this comes again to awareness, and also to not necessarily being a specialist in one thing, but having an awareness and an understanding of what all markets are doing and how all markets are linked. Because, just to use a recent example, if last week, for instance, you were only FX, only G10 FX. And all of a sudden at 6 o'clock last Thursday, you saw the dollar suddenly rip higher. You would have absolutely no idea what was causing that if you didn't know what was going on in the bond market. So I just think, broader perspective, you don't need to necessarily touch all these asset classes, but just to know the price, know where it is, know what's going on. That is probably the most important thing for me. And more people need to take a bit of a step back. Especially when you're seeing things like GameStop playing out in the market as well.
Yeah, I mean, I think what you're describing here is more of a macro type of approach to follow. But I think I can answer to, at least to some extent, why more people won't do it, because it's a lot of work. You can't be lazy and be a macro trader. The two are mutually exclusive concepts. I mean, to me personally, it's actually an incredibly lazy way to trade if you use purely technical analysis, for instance, and nothing else, and you think that you can have an overall picture of what's going to happen. But you'd be shocked to know how many people use nothing but technical analysis. And I've actually know a few traders who do that, and I've asked them, how can you even do this? You think you know what's going on, but you don't actually. It's all based on historical data. This doesn't always give you an indication of what's going to happen in the future. Well, am I wrong? I mean, I could be completely wrong, but that's just how I see it.
No, I completely agree. I will use technical indicators to try and get a picture of what's going on. Exactly, but not as the only indicator that I will use to tell me everything I need to know. That is in my mind not the way to do it. I would rather and do go fundamentals first, and then other indicators to back that up if necessary. And I think perhaps more people would benefit from doing similar.
Yeah, but as we said, it's a lazy approach to use only one thing in any case. It's like saying, I'm going to build a home, but I only want to use a hammer or a screwdriver. What's about a concrete mixer and a jackhammer, or diggers, or all these things. I mean, I think trading is one of those completely underrated professions in terms of, if you look at what we need to look at just to get a reasonable idea of what might happen in the future. Reasonable it is the word I would like to emphasize over here, because we still don't know.
No, nothing is for certain. Everyone is essentially, in the crudest sense of the word, making an educated guess on what they think is going to happen in the future. And as we always say, it takes two to make a market.
Absolutely. Jamie, I'm going to leave the last question with you. So, yeah, go ahead, kind sir.
So, Mike, I couldn't help but notice the other day that we saw, well, I won't mention any names, but some levels posted, and I think there may have been about 12 levels posted. No, again, that it kind of feels to be, in some ways, the sort of hot topic this year of option markets and people talking about different Greeks and stuff. Obviously, there's a big talk about gamma squeeze, but I think it comes back to the point that you were just talking about. Things, you can't just have one tool. There's not going to be one explanatory variable that explains absolutely everything. But yeah, I suppose when you see those sorts of things put out there, what's your take on them? When you see, I don't know, it's a strange sort of tweet, wasn't it? It was just sort of like 12 different prices stuck out, see which one sticks. But when those things come out, what are your thoughts when you see those?
Yeah, I mean, to liken it to my job, it's as if a client rang me up and said, where do you think cable's going to go next? What levels should I look for? We're trading 139.45 at the moment, and it's as if I give them 10 pips every 10 pips to the upside and 10 pips every 10 pips to the downside. It's ridiculous. Usually I'd ignore things like that. I was just in a grouchy mood yesterday, and so was the chap that I was talking about, as it turned out. Exactly. And all of his minions who decided to then torment me all evening. But I think it comes back to the point about where, on kind of social media and things like that, everyone can kind of appear to be a bit of a genius. And if you throw enough mud at a wall, eventually some of it will stick, I guess, is the idea that they're trying to get behind. But
echo chambers.
Exactly that. And personally, I wouldn't, take too much notice of it. I just think the kind of sad and disappointing thing is that there are far, far too many people out there who will take notice of that sort of thing, and worse than that, will end up paying in certain instances for that kind of thing. And I think that's just a bit of a broader problem with the market, really.
So I suppose awareness has been the key point of this hour, I think.
Yeah, definitely.
Yeah, it's become a lot, I don't want to say harder, but maybe a little bit more challenging or time consuming to separate the news from the noise. Especially with all these opinions being thrown into the mix all the bloody time, as you said, on social media. I think that does make trading a lot quicker, and it can be a massive help, if you follow the right people and listen to the right opinions. But boy, you can get hurt if you just take everything as the gospel. No pun intended, really.
Agree. And you can't take everything at face value. I mean, that's been the case for a while, but even more so than ever now.
Yeah. Mike, I just realized the time. I mean, with you, it's always such a pleasure to have a conversation. Time just flies, and I know we can chat literally all day long, but work's got to get done for all of us, and we've got to wait to see what Mr. Powell is going to have to say at I think 5 o'clock UK time.
Yes, about 5 hours from now, I think.
Yeah. So I just want to say thank you once again. You're definitely going to be invited on again if you would like to continue chatting with us. We would always love having you on board as a guest. And I hope that everyone listening to this really enjoyed it. I certainly did. I always learn something new whenever I speak with you. And you're just such a decent, great person to speak with, and you're always welcome anytime.
No, great stuff. Thank you again for having me on.
Yeah, it's such a pleasure. Anything from you, Jamie?
Just, got to echo Adrian's sentiments, Mike. Always great to chat with you.
Lovely stuff.
Great.
Thank you again, gents.
Thanks a lot.
Have a good afternoon.
And
you too, Mike. Thanks a lot.
Take care.
Bye, guys.
See you later.